And now, welcome to Primetime Accounting with your host, Michelle Relevance.
Good evening, accountants. This evening we'll be discussing the hot topic of accounting regulations. Is it too much? Is it enough? Today we will find out. Later in the show we'll be joined by two very established accounting theorists, both having years of experience but two very different views on the topic. First we'll have positive accounting theorist Richard B. Goodwell, who will talk in depth about the negatives of government regulation and why as accountants we should be able to roam free. Next we'll hear from political economic theorist Fatima Dividend, who will share with us her views and why we need to be subject to even more regulation. But first, let's get to the issue. New Century Financial Corporation was established in 1995, and as of January 2007, they were the second largest subprime mortgage lender in the United States. Due to the nature of the subprime mortgage industry, there is obviously a high risk of defaulted loan repayments. As we know, FAS 5 states that a liability for a contingent loss should be reported on the balance sheet if it is probable and reasonably estimated. Furthermore, FAS 140 requires a company to calculate its repurchase reserve at the time of sale at fair value. Herein lies the root of the subprime mortgage crisis. The largest of New Century's problems was its way of accounting for this reserve. It did not account for the interest it would have to pay investors or the loss itself would incur on defaulted repayments. As a result, in the third quarter of 2006, this reserve was underestimated by over 1,000%, as they reported a $63.5 million profit when in reality they incurred a loss. In this same quarter, KPMG signed off on the reserve based on the assumption that New Century would have to repurchase $70 million in defaulted loans, when in reality, KPMG's inside work papers showed that this number was closer to $140 million. In March 2007, New Century disclosed that they were subject to a federal criminal investigation and that they did not have the cash to pay back investors. As of March 12, 2007, New Century stock was delisted from the New York Stock Exchange, and on April 2, 2007, New Century filed for Chapter 11 bankruptcy. However, it is not all New Century's accounting practices at fault, as it was KPMG who allegedly failed as their duty of the public watchdog. In an email released in the investigative report, a KPMG specialist raises questions about incorrect accounting practices. They were replied to by the lead KPMG audit partner, saying that as far as they are concerned, the audit is done. The client thinks they're done, and all they're going to do is piss everybody off. Now, Richard, SEC Commissioner Lynn Turner is calling this Enron and Arthur Andersen all over again. Is this true, and what is your take on the current accounting regulation standards?
All right. Well, Michelle, in my opinion, we definitely do not need any more standards or regulations put in place. After Enron and Arthur Andersen, we had an increase in regulations. Now, with those regulations now in place, any more would just create bureaucratic red tape and do little in the way of preventing auditors from shirking and management from acting opportunistically. The positive accounting theory, which has arisen out of research led by Ross Watts and Gerald Zimmerman from the late 70s through to the 1990s, focuses on the contractual relationship between shareholders and management and the costs associated with keeping their interests aligned. Now, if you look at New Century Financial's management, they had acted as expected according to the bonus plan, the debt covenant, and the political cost hypothesis from positive accounting theory. By applying the bonus plan hypothesis, New Century Financial management had obvious incentives to increase their profits as they received substantial bonuses in 2005 and 2006. Using the debt covenant hypothesis, the reserves that New Century's management had underestimated, they would have put an enormous amount of debt on the company's books. Now, even if that liability were not infringing upon any covenants, New Century's management would have been motivated to minimize this reserve just to keep creditors and shareholders happy. And if you apply the political cost hypothesis, you would see that New Century Financial faced hardly any public or political pressures before 2007 and the subprime crisis. Now, without those pressures, there was no incentive for management to minimize the reserves during that time. Now, the monitors of this relationship, KPMG, they had shirked on their responsibilities and did not uphold the regulations that were already in place. Apparently, KPMG did not receive a suitable incentive required for them to properly perform the audit procedures. So this is not a matter of regulations, it's just a matter of upholding contractual obligations.
Thank you, Richard. Now, Fatima, we have a quote here from Richard Dietrich, chair of the accounting department at Ohio State University, saying that the SEC's liberal interpretation of FAS 140 has left a hole you can drive a truck through. Would you also agree that the profession needs to be better regulated?
First, thanks for having me on the show, Michelle. I'd like to start off by explaining what the political economic theory is. Political economic theorists, such as myself, recognize that there are two components of capital. One is the physical means of production using economic forces, and the other is people's relationships in social organizations. These two components are interconnected. The social institutions provide rules for economic production. These rules include accounting regulations, as accounting is an essential part of economic production. The purpose of social institutions such as the state is to provide regulations and protect rights and obligations. We also recognize social inequalities. These inequalities exist because of access to property and reliance on the marketplace. Regulated accounting can balance some of the inequalities. Just look at what happened with New Century Financial and their auditors KPMG. As we've already discussed, Michelle, KPMG failed in their role as New Century's auditors. They signed off on numbers that they should not have. If there were more regulations, all this could have been prevented. I know Richard gave you some reasons why more regulation is not needed, but the fact of the matter is, regulation will serve those of you at home, the average person. In the words of the famous political economic theorist, Tony Tinker, regulation will also protect the general interests of capital and corporate firms. Richard and other path theorists may see this as a radical view, but in the end, regulation will ensure the survival of capitalism. In the case of New Century Financial, there are inequalities between shareholders and managers. If accounting was to be used as a social inequality resolver, as it should be, New Century Financial would not be where it is right now.
Thank you, Fatima. Well, there you have it, both sides of the story. Now you decide. Good night, accountants, and keep those pencils sharp.